Good morning. This is Bakes, Kevin Baker with Bakes Takes. Welcome to the podcast. This is for the week ending Saturday the 6th. All the things that I've read and the podcasts I've listened to over the course of that time. And let's get right into it. Number one, I'm wrong on stocks for now, but I didn't lose money. Big difference. Number two, I put on some pounds. The COVID-19 quarantine is beating my MARSOC workouts. Neither one nor two are permanent. Please check the YouTube video before you can see my workout. I'm kidding. It's a military guy that's in shape, and I look like an epileptic water buffalo when I do it. Please, no hate mail or social media trolls from the water buffalo community. I appreciate that. Number three, it'll be tough to make money in bonds from here. I came across a chart that we'll get into. So here we go. Let's go right into it. We talked about this last week. This is the 60-40 portfolio we talked about last week. Obviously, stocks rallied nicely at the end of the week. So it's down 0.8% at the end of the week. The bonds are up 4%. Gold is up 10.6% year to date. And cash is flat, obviously. But it's up 1.1% year to date, the 60-40 portfolio. So with all this madness going on, pandemics, riots, etc., we're up 1.1%. And again, thank you, Chairman Powell. He is flooding the market with liquidity, and it's going into stocks. It's almost that simple. Mike, let's go to the I call it my portfolio. Back in September, yes, I'm beating this dead horse. I admit it. But I was right. So I'm going to, point that out. I suggested that, with the unprecedented nature of the way the length of the bull market and the record low yields of bonds, it made sense to maybe take your 5% cash allocation to 10, and the same with gold. And if you did that, this is what happens. So year to date, it's up 1.9%. Again, the S&P is down 0.8. The bonds are up 4%. And gold is up 10.9, and so all in up 1.9%. Again, in an era of madness, not too bad. It's June, so Ned Davis had a great phrase. Wonderful research fellow who has his own firm, and he said, "There's being right and there's making money," and I obviously prefer the latter. So I'll get into my mistakes, and you can flog me later if you want to, but. So that's what's going on with, your portfolio if you have an advisor that you like, trust, and respect, which I mention all the time. And I think that 1.9 and or 1.1 is a gift given what's been going on. And I think it's remarkable. I think we have a lot of wood to chop, but so be it. I want to get into you versus the pros. I think, and I'll just speak for myself, I want to make money every year. And I want to compound. Now, that's obviously very difficult to do. Markets don't always oblige me. But if you compound positive returns or very small losses year after year after year, you tend to do really, really well. Pros are focusing on outperforming an index this year. I say it a little tongue-in-cheek, but it's pretty real in the financial world. Is that if you underperform for a year, you get put on watch, and if you underperform for 2 years, you get fired. And so if their benchmark is the Russell 2000 growth, that's what they want to beat. That might mean it's down 20 and you're down 10, you get to live to fight another day. So what I think is happening here to an extent is we are, you see the pros that are running mutual funds and hedge funds looking at the calendar. It's June 8th. The quarter end is coming up, and you've got to write an investor letter that explains why you are underperforming or outperforming. And if you're underperforming, you're probably playing some catch-up. And you're saying, okay, what are the names that I really want to show people at the end of the month, and I'm going to top those off, and you see what's going on with, the 5 big tech names, etc. And but the pros have a different incentive than you. I think doing nothing is completely appropriate for retail investors, private investors, most of the time. I am going to find something to invest in. I'm going through 1,700 plus charts every single month. I just haven't found anything. I reviewed my prior podcast to self-evaluate, and I said I'm looking at shorting the emerging markets or shorting high yield, but I never had buy points and I never recommended them. So here we are, up 1.9% with less risk while we research before we pounce. Not too bad. So be it. Here's the S&P. I'm wrong for now. I focus too much on volume, and it normally works, and it didn't this time. And, nothing works all the time. Friday was the first time we had an up day on above average volume, up 25% above normal. I usually want to see that 50% above the normal volume. And but price is what you cash in. So if volume doesn't work this time, mea culpa. I apologize. I dislike.
Can I ask a question real quick? So, I know you've pointed out you were wrong about the stocks a couple times, and I just want to step in for a second because we live right now in unprecedented times, right? I think what I've heard is that I've heard you take a model that has worked repeatedly, right, and applied it in a time when it's chaos, right? I mean, it must be extremely difficult or almost impossible to accurately predict anything given the current climate, politically, socially, with COVID-19. I mean, there's too many variables for it to just be as simple as, when volume is applied, it will get you these results and so on and so forth.
I appreciate that. I just don't want to be, one of the guys that shows up all the time. So, I'm right all the time. And I think I have to be human.
Oh, of course.
And these are crazy times. The pandemic, the racial tensions in the country. It's crazy. But we've been talking about this. It's the Fed is Superman.
Yeah.
Chairman Powell is Superman, and we haven't found his kryptonite. We talked about it last week.
Yeah, we did. Yeah.
And we'll talk about that more, in subsequent charts. But people want to own stocks, and there's reasons for that too. Bonds are at record low yields, and even though the S&P yield isn't terribly attractive, it's better than what fixed income offers. So again, we're still making money.
Yeah.
And so I just I have focused on volume because it's worked for me most of the time. It doesn't work all the time, and here the jobs report came out. And 13.3% unemployment is apparently good news versus expectations, and so they moved stocks up huge.
Yeah.
And I didn't see any of that coming.
Well, I guess that's the thing. Nobody saw any of this coming. Most of us, you know what I mean?
Yeah, that's true.
It's a lot of it. A lot of it is just crazy stuff that's happening.
Yeah, and what I want to do is I want to take the information that's out there. I don't want to regurgitate it to you and to my audience. I want to find potential future implications and then find ways to invest in it. And I'm going to be honest. I'm not going to say that, I'm clairvoyant and I'm right all the time. I just think it's disingenuous. I dislike watching economic reports. I've mentioned that many times because I can't find an unemployment ETF that I can make money on. There was no way to say, hey, 2.5 million jobs and, I'm betting the over. You can't do it. That might be a business opportunity for somebody, but the jobs report is what it is, and 13.3% unemployment is good news for now. And stocks are close to record highs. NASDAQ is at record highs. So, and this dovetails with what you talked about, Mike. The S&P yield is down to 1.96 from 2.3, and with the jobs report, Treasury yields are starting to go up. We were at 65, 70 basis points. Now we're up to 90. But the S&P yield is higher than bonds, and so bonds are looking attractive, and it's getting those extra flows. There's a ton of money in cash, and it's flying into stocks. Largely expensive stocks, but it's running there just the same. Here is the dividend yield, the S&P versus the 10-year, and most of the time, bonds yield more than stocks. This is, again, unprecedented, the widest spread in 10 years, and it's just starting to narrow. But I think that people are saying, I don't want to be in fixed income, I want to be in stocks, and the Fed has my back. And there we go. I was surprised by this. This is 50 years, and I always like to, the longer the time frame, the more impactful it is. Bonds have been yielding more than stocks for most of the last 50 years, from 70 to 2008. Bonds yielded more than stocks, and we've only had periods over the last 12 where stocks yield more than bonds. And frankly, I don't know about. I thought dividend cuts were going to bring this number down more than it has, but here we are, and we're at all-time highs for this ratio, and so the stock market is getting the benefit of the doubt. The last few days have pointed out the Tina effect. I underestimated. There is no alternative. TINA. It's bigger than I thought. And that's part of the reason why stocks are doing what they're doing. But by the way, we're flat for the year, so for the S&P 500, so no one's making any money. It just feels better than being down 33% in a month, which is what happened before. This chart again surprised me too. This goes back to 1965, and yields are about as low as they go. We went from 15 plus to 54 basis points over the last 40 years. Been absolutely remarkable. We're bouncing off that low. We're now at 90 basis points, depending on the day, give or take. And I just point this out that, I don't think we're going to get negative rates. I don't know that. But the only way you make money in bonds from here is if rates go back down to 54 basis points or lower. I think that's a very difficult scenario to envision. And I also think that 137 level is resistance, but I think there's very little keeping us from that. So bouncing from 90 basis points to 137 seems reasonable. Here's my Bakes take to really pound it home. I think bonds are ballast for asset allocation. They tend to go up when stocks go down, etc. But I think making money in bonds is going to be really tough from here. So there we go. And I left this up here just to sort of punch me in the mouth a little bit myself. I said close above 303. We got that. Volume remained below average, and the market is a mischievous bastard. And it fooled me this time for now, and I got more work to do. And here we go. I had a great call in from one of my son's friends, David J. from Bucknell, my son's alma mater, just graduated. He's a classmate of his, and they have a great program at Bucknell where the students run a pretty sizable portion of the endowment fund for the school. And he asked, Lululemon has been a huge winner. Is it set for readjustment? And don't know really what you mean by readjustment. I'm going to say that, should you buy, sell, or hold? So that's how I'm going to interpret it. I'd re-examine your target, and what I did was I called my son's friends. My son is Jack. His son Charlie recommended Lulu for the fund, and I got to give him a tip of the hat. Did an incredible amount of work, and recommended it at 201, and that's back in April. And here we are at 315. And Charlie, good for you. Great work. By the way, his target was 235. He said I could say that. And so what do you do from here? And I'll tell you what I think you should do. I would re-examine the target, and if you can find ways to make the numbers work where 315 looks cheap, then so be it. I think when you have a 50, close to 60% move in 2 months, I think you should just say thank you, Mr. Market, and sell the original investment, and then let the rest, let the profits ride, and then I would implement my sell discipline. We can go into that down the road, but it's a 3-step process where it breaks the 200-day. The 50 comes down through the 200-day moving average, and the 200-day turns down, and you get out in steps. But at 315, you're so far above any of those things going on. I just think you let the rest ride and take the original investment out and use your profits to participate going forward. Why did the stock go up so much? Well, leading up to the earnings report, there were 24 down revisions. Everybody saw what was going on. The world was shutting down, And apparently we like yoga pants. I'm wearing some right now. I'm kidding. I'm not doing that. But you can order online from Lululemon, and people have. And the expectations came down. They beat the top line by $15 million, $1.4 billion. The earnings estimate came in 3 cents above, and then they raised. So the market was prepared, coiled for bad news and maybe downward revisions, and Lululemon beat, and that's music to the market's ears. And they took the stock up huge. I'm sure there was some shorts that got caught and had to cover, and so you had a maybe an exaggerated move. So now expectations have been raised given that report, and so the next report is going to be given, I think, less of a pass than this one was. The stock's expensive. It always has been. I'll go into why, and it probably should be, but a 74 PE is an expensive stock. And 10 times sales doesn't leave you a lot of room for anything to go wrong. Right now, very little is, but you can't say that valuation is much of a backstop here at this point in time. Net margin 16%. Return on equity is great at 38%. The top line growth 19%. Bottom line growth 36%. Great numbers, metrics all the way around. Growth is coveted in any market, but especially this, where so many industries are getting battered. And so you can't argue with the financial performance of the company. You can't argue with the valuation. Can you go to the next one, Mike? Thanks. I look at this sometimes with these more controversial names, and I look at the shorts. There's 4.5 million shares short. That's up a bit, so that implies that there's some skepticism in the market. It's 2.5 days short, not a heck of a lot. So the market can absorb short covering. So you're not likely to have dramatic squeezes from here. So you don't have that technical short interest fuel that's out there to push the stock meaningfully higher from 315, in my opinion. Balance sheet, $1 billion in cash plus, $739 in debt. So net cash on the balance sheet, free cash flow of $306 million. Again, business is really good. The balance sheet is very strong. It just comes down to valuation. So here's Bake's takes. Boom. Take the initial investment off the table, let the rest ride, and then look for, I think, down the road, maybe end of the year, beginning of next year, to follow the sell discipline that I outlined, so that you get out in stages, but you don't get out prematurely and let, frankly, my or anybody else's valuation decision get you out of a winner when it clearly has been phenomenal. Charts this week. This is the medium-term VIX, the volatility index. Pro shares. This is the ETF futures. VIXM is the symbol. It's picking up on a day that the market's up big, and not sure why, but this is impressive volume, 5 times normal. It's that blue spike you see down there in the lower right. And I'm drawn to things like this. I mean, why is it? It isn't an options expiration, so something is going on where people are anticipating higher volatility, both up and down, over the next 5 months or so. And that gets us into the election and the end of the year. I think that makes a lot of sense. So I'm watching this. I haven't done anything with it yet. I'll tell you if I do. This is just, showing where multiples are with Jim Bianco. I really like his work. And I put down, I know it's different this time, but stocks are expensive, and but that doesn't mean you should sell everything. That just means that you should know where you are and be a little bit more wary and be ready to sell any questionable stocks that you have in the portfolio. Small caps are more overvalued than any time in history. The put-call ratio, I said we need to get a bigger chart, like the captain on the Jaws boat. People are buying calls at a higher rate than puts than the most ever. Over the last 20 years, the put-call ratio which means that people are making bullish bets versus bearish bets, and it's at an extreme. More extreme than 2008. So I just think that caution is warranted, and I'm going to provide plenty of that. Please subscribe, review, and share my Bakes Takes podcast on Apple, Spotify, or your preferred platform. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter, at BakesTakes_ and other social media. Please use your voice memo app. Tape your questions and email to bakes@bakestakespodcast.com, or write if you prefer. I will also keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Have a great week. This is Bakes with Bakes Takes Podcast. And for much needed levity, again, I can't play the YouTube video because I don't have the copyright and I don't want to get in trouble with San Bruno. Watched The Joker with my son the other day, which is a disturbing film, frankly. But Gary Gulman does his college professor role play bit. I think it's very funny. I hope you do. And I hope you have a fabulous week. And I'll see you next time. Take care. Bye-bye.